Thank you very much, Daniel, Professor. It's wonderful to be back here in Athens. I think it's right that we broaden our focus beyond the banking sector and think about what we call NBFIs, or non-bank financial institutions. I agree the definition is a bit blurry from place to place. But I think I'd make a couple of points just to remind us all why banks are so important. Firstly, with everything we've seen over the past 13 or 14 months, it's still been the banking sector where we've seen pockets of risk crystallize. So we cannot forget about Silicon Valley Bank. We cannot forget about Signature Bank. Credit Suisse was another very timely reminder that banks can fail long before they get anywhere near insolvency. Banking remains a confidence game. You have to persuade your customers and your investors that you will manage your risk effectively. And if you lose that confidence, then very quickly you can fail. And banks still play roles that are incredibly different from the non-bank parts of the financial sector. So, when I think about direct lending, for example, which NBFIs have done a lot of, private credit, investment firms and companies lending money directly to businesses in an intermediated way, but not in a transparent way like banks do. Yes, of course, we see the risks there, and we worry about the ability of some of those players to manage their portfolios, particularly given the explosion in direct lending over the past 2 or 3 years. We worry a bit about how transparent they are about defaults, to be entirely honest, because we're pretty clear about what we call a default. Sometimes I think things that we would call a default, they won't, so we worry about the comparability of data. But even if you saw an issue there, the fact remains that NBFIs do not create money. Banks do. That's the nature of the way that banking works in advanced economies nowadays. And they are also not as embedded in the infrastructure of the financial system, and particularly payment systems, as banks typically are. So, of course, we worry about risks everywhere, but I think there will always be good reasons why we focus on the banking sector with regulation. In terms of what needs to happen going forwards, my focus at Moody's is really about how these inherent problems in particular parts of the non-bank sector could become systemic. So, let's just be absolutely clear. If you believe in some aspect of a market economy, you believe in the freedom to lose your money for a risk to crystallize and you suffer a loss. That inherent risk in and of itself is exactly what economies should cope with. Whether that becomes systemic either through counterparty risk or through triggering asset price declines elsewhere, or through a general shift in contagion around risk appetite from investors, those are the kinds of channels I think we need to worry about.
And is there any one of those channels in particular that you have your beady eye on right now?
The one that worries me the most is the contagion channel, because you can have an issue, you can have a problem in one part of the sector which may be totally unconnected in a direct way to another risky asset in another part of the financial sector, but it still has the potential to trigger correlated asset price declines, which then can fill into fire sales and other issues. And that kind of psychological linkage is incredibly hard to deal with. We had a mini government in the UK last year, and one of the reactions to their budget measures I would characterize in that kind of form. And that's where, to pick up on one other big change since 2007, 2009, I think the shift from policymakers has been incredibly important. And with Credit Suisse, with the US banks, we saw policymakers step in very quickly. With the gilt market meltdown in September, October last year, we saw the Bank of England step in very quickly. And in all three of those instances, they weren't following a prescribed rule book. The US extended deposit insurance, the Swiss rewrote the rules on Sunday night in terms of changing the law. There was no playbook for the Bank of England. So I think the emphasis on responsive policymakers as guardians of financial stability is also a positive.